Do any of the panel members feel some type of way about off-time roadmaps? Okay, no worries. This will be a speech on the speedier side. I don't think it'll be as fast as a cases speech. So, if you need me to slow down, unmute and say clear. I really don't mind. Two pieces of framing. I think four arguments. All right. This strategy is not permanent. Obviously, banks adopt financial strategies for given periods of time. The question of the round is which strategy to adopt right now in the current market. Second, note the motion's clarification. Just go and read it in Discord. This is a domestic bank. Our first argument is that fortress accounting is much better in the current domestic market. Why? The current Trump administration is nuking America's financial stability along several vectors. First is tariffs. Obviously, there are these nebulous tariffs that are getting renegotiated monthly that are scaring international companies from sending money into the US, but are also scaring US firms because they don't know what products among their supply chain they're going to be able to access. Second is investment. America is a highly volatile market right now, especially as American corporations that are very invested in the banking structure are unsure what their bottom line is going to look like in the future. This is scaring both domestic and international investors, which is why we see so much money fleeing to Switzerland. Third is enforcement. The admin isn't actually enforcing things well. Rather, they're picking and choosing which companies to audit or which companies to enforce ongoing regulations against. Businesses don't know who to pay or what to put on balance sheets. This is especially problematic as the administration has demonstrated a high level of vindictiveness if its policies are perceived as being skirted. This is why Trump is constantly going after different institutions. Fourth is the Fed. Trump is attempting to politicize the Fed right now. He's going after Lisa Cook because they aren't cutting rates like he wants. This makes bonds extremely volatile. Having debt fucks you over when interest rates shift. Higher risk of overaccumulation of debt with variable rates means the bank is more likely to suffer if invested in things like bonds. And I'm sure Bart Kaminski's previous partner, our chair, is aware of what high debt in a volatile market does to you. Why would Trump crack down hard on the Fed? First, he perceives them as in line with the previous Fed. Jerome Powell was backed by most industry experts and leaders, including the people he's currently going after. Second, show of strength. He wants to assert political strength over previously independent government functions, namely banking and the judiciary. Third is to appease his base. Americans generally despise the economy right now. It was polled across the board as the most important issue of 2024. Trump wants to capitalize on his mandate to overhaul the economy and appease his angry base by targeting banks. What are the impacts? Off banks probably just falters. It takes too many losses. It overinvests in a failing market and accumulates too much debt. Variable rates due to America's instability then cause it to have to make too many payments back from its reserves and investors lose money. We are insulated from the backlash because we are not overinvested. We're holding cash reserves. We're taking on low debt. This means we're relatively better insulated from the economic shocks that are to come. Trump's administration is like 12% done, guys. We got a long road ahead. Second is international market shocks. The international market is extremely volatile currently. 4 reasons. One, mass tariffs from the US and counter to the US affect the importing and exporting capabilities of firms, which affects forex markets. Second, decoupling of US and China causes mass geopolitical tensions arising. It's more likely we see countries that previously played off of both US and Chinese financial interests having to pick one, and their firms and general economy decreasing as a result. Third, banks are moving off of the US dollar standard. They're switching back to stuff like gold or Swiss banks, etc., which is decreasing the capacity of the US to leverage its economic strength. Fourth, countries have stopped trusting the US because of the Fed's politicization. So they don't trust the US to be able to properly control and monitor the supply of money, which means they're not lending to the US. And note that the ability for your bank on up to make back the debt that it has leveraged is by the US receiving lending from international countries. So if this is going down, then it is likely their bank goes down with it. All of this means they're likely to be international market shocks. This means 2 things. One, international investors would prefer to invest in our bank on Gov as opposed to other banks that are less risky, or even if they just perceive it as such. Second, many large US companies have massive overseas contingents. Tesla getting lithium from China or having Chinese competition, Nvidia versus AI. Thus, international shocks are massively likely to affect domestic companies, which are the companies your bank is likely to invest in on up. Why do we still get growth? 4 reasons. The fourth one has a lot. One, we still have the ability to take on debt, just a low amount of it, and we can still invest in profitable projects that are better insulated than the type of investments you're likely to make on up right now. Second, we can still source capital through equity and other forms of funding to invest in projects that are less rigid than just straight up taking on debt. Third, we're still a top 15 bank. There's likely long-term projects we are already invested in and working on. Things like integrating AI, updating software, etc. And none of this requires massive amounts of debt in the first place. Fourth, by doing fortress banking, individuals are more likely to deposit their money into our checking and savings accounts because we're holding on to more of it and are less susceptible to insolvency. This means we actually get more money because even if we use less as a percentage of it, we get way more individuals to leave money in our bank because we're perceived as safer. We're holding on to more of their cash rather than reinvesting it. So on their side, maybe they hold 10% in reserve. We hold 20%. We are likely to get more than a 10% increase in the amount of people leaving their money with us due to the mass instability that's going on in banks that are choosing up strategy. A couple reasons why people are especially likely to dislike mass growth attempts right now. 3 reasons. 1, people perceive the market as being a bubble. Stuff like AI and Nvidia and Tesla stock prices have tanked already. In these times, they'd rather prefer resilience. 2nd, 2008 is far too recent and far too devastating. Everyone thought that the Lehman Brothers were too big to fail, but was over-leveraged, had way too much debt, and collapsed. 3rd, the cost of debt will be high, per the above arguments, so solvency is in question, whereas on our side of the house, by maintaining low debt, people are less scared. This actually means that on Gov, we just get more money and can still invest in projects, but we can do so better, because with this extra cash flow and the need to take on less debt in the first place means 1, our bank is larger and growing while maintaining resilience, and 2, even if we get less growth, we likely still get enough to appease investors. Risk in the market is more important right now due to instability. 4th, this is our 4th argument. Why do shareholders support this strategy? For all the reasons above, they know right now is highly volatile. Why do our current shareholders care more about protecting their investments than growing them right now? A couple reasons. First, the simple pain and pleasure analysis. Shareholders care far more about the number that they have accumulated staying the same versus it going up. Were the bank's investment strategy on up to not pay off, even for a single quarter, shareholders will feel the pain more acutely. This is because the level of wealth they have grown comfortable with is perceived as shrinking, which is a far greater psychological shock than growth, because we as humans index our happiness on thresholds of pleasure, i.e., when I eat a really good burger, I call it the best one I've ever eaten, and I compare every future burger to that best one. The same way how if a rich person is used to having 100 million, if that goes down to 99 versus up to 101, they care a lot more about it not going down than about it going up. Second is that the shareholders aren't fucking stupid. They know the economy is highly volatile for all the reasons above, and they know slow growth is possible with safe investment. Third is risk. Shareholders and rich investors, the ones who do pose a risk for the bank if they withdraw their funds, are also invested in hedge funds and other banks that are being risky, which means they want a certain amount of their capital safe with a steady bank, which is what we can provide. Note that because we are growing, our shareholders have witnessed relative growth recently. However, because we're top 15, we've existed for a while, which means our shareholders probably saw us take similar strategies during COVID and saw it pay off, which means they do get behind this slow growth strategy. The impact of this is not only that we maintain our current investment, but that we get more, because as other banks play it risky, more shareholders flock to our bank as a place to keep their money safe. Very, very proud to propose.
All right. Very nice. Some quick pleasantries. Very, very happy to be in the semifinal round. This was a last minute decision, and it is very cool to be here. Happy to be debating with James and the BDU again. Very happy to be debating against Yuki and Ryan. Had a tough round against you guys earlier in the tournament, and now we're doing econ. So let's see how this goes. But happy to be here nonetheless. And thank you to the judges and the spectators for making this possible. All right, it'll be off case, on case. 2 notes at the top on framing. First, that you're a top 15 bank on the rise, which means 2 things. First, you probably already have some reasonable reserves, given that you're one of the 15 largest banks within the country, and probably enough to take some, baseline risk. And secondly, that you just have some existing clients and connections. So we say, even in the case you now start to be riskier or maybe take some losses in the short term, you're likely to want to continue to invest in you, given that these relationships already exist. Since you have some resilience and something to fall back on the op side, and thus some reasonable capacity to take risks. The second thing to know is that fortress accounting is likely super duper conservative on the far extreme side of the spectrum. This means very investing in industry have a very low return on investment per year. You save a lot of money instead of investing into other things and things like this, because the only way for you to be a fortress, especially if the economy is as bad as a PMC characterized to you, is to do next to nothing and be practically a sitting duck. This is a necessary framework to buy into if there is going to be a large delta within the round. Our slow contention within the round, and then is that you have a more rapid and sustainable rise in our side of the house. There's a bunch of reasons why it's the case. First, is because you attract more investors who want want to make a return on investment within the current economy. You're able to do things like grow more quickly because I'll get this later. Or no, it's because if they're right, and the overwhelming amount of people are scared in the current market and don't want to invest into things that are super risky, even if that is the case, you're still going to be the largest investors who either are able and willing to take risks, or two, who invest into riskier industries as a way to hedge against the rest of their investments. So the best thing that you can do as the bank in this case is be the one taking those risky investments, so you can attract this hedge investment. You're then able to grow more quickly, diversify your assets, and take on greater risk by investing in new and up and coming markets. You're probably quite smart given that you're a top 15 up and comer. You've been able to break this top 15 as a new bank. It's also important to note, secondarily, under this first layer, that there is a revealed preference for the investors to be risky. No bank just happens to spawn at number 15. The types of people who invest in a bank that is on the rise are the ones who are willing to afford the risk of the bank failing, if not going for the top pedestal of power. It's likely you've engaged in traditional accounting thus far for you to be able to have risen to the point where you are. Therefore, it only makes sense in order to guarantee those investments and to continue to get them to trickle in, you have to continue along the same path by calling it before calling it early and playing the pass of the game. The second layer to this argument is that the market is quite amenable to risky paths at the moment. A couple of reasons why it's the case. First, because the tariffs have made the market mad and stable, as the BMC characterized you, and even traditionally safe industries have been volatile. This means that being safe is far, far harder to do, especially for a top 15 bank that's still being outcompeted by the fucking Chase and Discoveries and top fives of the world, and thus less effective than it otherwise would be. So your capacity as a smaller bank to be safe and play it safe is far harder. Secondly, lower regulations and less oversight under Trump decrease the probability of being cracked down on for doing risky shit because they aren't investigating the fuck out of you because they're already very pro-corporate and very pro-business, which is you're more able to do things that might be screwed the legal line a little bit, might be good at money in slightly unethical ways, but it is true because the government's fine with it. Third, following that, there's a Republican trifecta. They control Congress, the Supreme Court, and the presidency. And the pro-corporate governments that likely side with you in the case of lawsuits, or if you're helping, or if or help you for struggling. There's an optic consensus of them. They don't want the bad PR associated with a top 15 bank failing. Trump uses private companies as a way to increase American legitimacy and prestige, i.e. helping BlackRock buy the Panama Canal. So he clearly wants to help private businesses do well so he can claim credit for it. This means you're ever going to be aggressive. Right now is the best chance to do it. The third layer increases the weighting under the second reason. The third layer says that the rise is more sustainable on the offset for a few reasons. First, and most importantly, you need to go for broke. That is your only way to survive the volatile economy that currently exists. If you are only top 15 and the recession hits, your savings probably won't be enough from saving you from either one, getting absorbed by a larger bank, which is more likely to get bailed out by the government in the case of recession because they have more money, they impact the economy more, and they have more connections to the government. And secondly, it also makes it more likely independently if you're a large bank and taking risky investments and growing rapidly that you'll receive a government bailout in the first place. A recession is like decently likely to hit for two reasons. First, because of all the tariff instability and warranty that PMC already does for us, but secondly, because of massive bubbles that are currently forming, i.e. housing, which is overvalued and like a bunch of like millions of empty houses because obviously the price is too high. Things like AI, which is like fastly out, like there's too much investment that the return on investment into AI is quite low. They've already given the example of Nvidia, and things like buy now, pay later bubbles, where people are like fucking like paying, like renting out their fucking DoorDash, whatever the fuck, which are massively speculative and likely to burst in the coming weeks or months. It means your best chance at survival is becoming big enough to receive a government bailout, and the only way you have a chance at even becoming big enough to receive a government bailout and avoid getting bought out is if you choose to be more riskier. Also, the greater short-term ROI in your bank, the more investment industries are going to be advocating on your behalf, which increases lobbying pressure against the government to bail you out. The Silicon Valley bailouts are a good example of this. The second part under this last layer is that you build relationships with investors in industries that likely want to succeed. It's hard for them to find new partners and new banks. It takes time for them to change products. It harms production in the meantime. Whenever trying to change like all the new like legal regulations, things like that, they have to pay the legal costs associated with changing contracts and changing providers. This all means that the partners that if you go risky right now, if you form new relationships, these new partners that you attract will be through giving them preferable deals will likely want to advocate for you to succeed. And the greater the chance that the investments that you make are diverse enough for you as a bank to succeed in a volatile election. Moving on to the on case, on their first contention of a much better domestic environment, they talk to you broadly about things like terrorist investments and enforcements. And there's three ways that we beat their argumentation. Like first, it's just like Fuck it, bro. Take a chance. It's like if you see like a UFC underdog that's like fucking, I don't know, like plus 1,000 or something, and you're like, shit, if I invest like, a cool little 5 bill, maybe it'll give me 100 back. Fuck it, why not? You still have a chance of making large investment under that, especially if you're fucked anyway and the economy is as bad as they characterize it to be. Exactly, this makes fortune accounting even harder as well, per the characterization it gave you in LLC. If you buy the full extent of the PMC argumentation, even bonds, which are the most stable fucking thing ever, are volatile in the current moment. The same thing goes for housing and other things like this. So it's unclear to me what the safe things that you can do on their side are in order to continue to survive this volatile economy, especially as a top 15 bank that's still being outcompeted by the top five, etc. Third, it's better scale on government's good side, i.e., by going all in on industries that Trump is trying to build, things like U.S. steel or car manufacturing, even if it's risky, because that's when there's the greatest chance that the Trump administration is willing to bail you out or do something to, slide you a little bill or something under the table. They talk to you about bonds, but one, isn't this the main way that people do fortune accounting anyway because it's perceived as the most stable? It's unclear to me exactly how this looks on their side of the house. Secondly, I don't know, bro. Just like invest in the industries and countries that are on Trump's good side and clearly aren't willing to piss off Trump. I don't know. I'm not that good at econ, but I'm sure that they have the fucking greatest fucking U Chicago alum or whatever the fuck at their banks, so I'm sure they can figure out what they're doing. Their second contention is on international market shocks. A couple of, we said that the overall response is that your bank is guaranteed to always get outcompeted by one of two groups. Either first, you will be outcompeted by larger banks that are far more resilient and stable for international investors. If I'm an international bank, why the fuck would I invest into a top 15 one? I can invest into a top 5 one that is more likely to get bailed out if a recession happens, as a larger, like already existing amount of stockpiles and money saved up in order to survive the recession. They have far more connections, things like that, to be resilient. So it's unclear to me exactly what Team Prop does to differentiate yourself from all the bigger banks that do what they want to do, but far better. Secondly, there's also banks in other countries that are presumably far more stable because they aren't impacted by fucking stock market swings or dependent on whether Trump wakes up with like a fucking spot in his hand or not, or like the mood that Elon happens to be in. These are probably far more stable compared to investment to American banks or American sectors because you don't differentiate yourselves in any way. You have to offer an immediate short-term return on investment who's even be willing to take a chance on you. Even if this means that they invest into you in the short term, that's still perfectly fine because it gives us some means to which to survive the short term right now that we otherwise are likely to have. I think that broadly the third and fourth contention relied on the same mechanism, so I'll respond to them together. There's three responses. First, I think there's short-term pressures that you as a bank need, or that investors need the equity now. They want to take risks in the market and get a shot at getting rich or getting bailed out later. Again, the best chance that you have of survival is if you get big enough to get bailed out by the government. Secondly, I don't think that they can predict slow growth. Like, you don't feel comfortable enough predicting the market in that long of a term, which is why investors would be unwilling to invest into these sorts of slow growth banks. And thirdly, is that investors invest into some safer industries, but they also invest into riskier industries. If Gov is right and most other banks or investment banks are taking a conservative approach, then you can attract them through being more aggressive.
Okay, hello, hello. There's gonna be two overviews at the top, and then it'll just follow the LSD. See what I think? Yeah, I'll read that at the top. Okay. Is everybody ready? Three. The first overview is on how investment works on our side versus their side of the house. Our argument is that we don't fucking invest in anything at all. That'd be fucking stupid. You're wasting your money. Our argument is that you go safer with your investments and you do it with less leverage. The specific difference that y'all want to highlight in background is specifically like the amount of debt that you raise, for example. And obviously that's leveraging the amount of money you have because you borrow on collateral of the things you already have. Which is that on their side of the house, when you make investments, it's with money that you owe to other people, which is that it's much harder to pay back if your investment's worse. But on our side of the house, you do it with the reserves that we already explained that you have. You're a top 15 bank. I'm not sure why that difference is specifically necessary in like some stuff you invest in. And secondarily is obviously the way you invest in things is by hedging and stuff like that. So in our house, you're more likely to put more of your money on hedging positions. So maybe like the amount of money that you end up making is a little less overall, but you're less likely to lose mass amounts of money that you're about to lose on their house because they're over leveraged and they're also not hedging their bet properly, which means on our house, you do stuff like buying both like long and short options at the same time, put and call options, or do like delta dynamic hedging, which obviously is like stuff that we can access on our house. We probably have enough money to be able to make a decent amount of money through this. Like, yeah, we're not saying we're gonna be making
taking like 25% and become the best bank in the world, but we're also saying that we're not over leveraging ourselves and we can still invest a decent amount such that our investors are happy. Second overview is that collapse of the market is likely to soon, and this is kind of their argument, which we'll just turn. The banks that needed bailouts in 2008 were the large banks that invested way too much, that were over leveraged, that were like fucking knee deep in the shitty the mortgage-backed securities on their house. Small banks that took on high debt were the ones who got fucking bought out. The only safe banks were the ones that had enough cash reserves and low enough debt that they could withstand the storm. There's a bunch of reasons why bailouts likely gonna, or why the market likely gonna collapse on their side of the house, which or either side of the house, which they kind of concede, just like the mass bubbles argument. There's shitty securities. There's like mass securitization, buy now, pay later, Fed politicization, etc., and all that stuff. Why is the market failing in immediate gut values? One, you hedge more against this by taking less risky investments or having more cash reserves, so shareholders and consumers know your bank's much safer for them. And also, guys, it's not like like the more money you incrementally have, like the more likely you're going to get a bailout, or the less likely that you're, or like the less likely you're going to need a bailout. No, it's the amount of money you have versus the amount of money that you owe to people. So in our side of the house, you owe way less money to people. So even if we are making a little bit less money or something, the difference in the amount of money you owe to people versus the amount of money you hold right now is enough such that you're able to sustain yourself. But there's a house you don't, because you're over levered. You owe the government now more money or something because you're taking on way more debt, or you're taking out debt from other investors, which is down on their house. You owe way more money than the amount you can ever pay back, even if your investments are somewhat profitable, which is down on their house. It's likely to happen, especially if the market collapses. So they don't understand fucking anything about how bailouts work or how going under works. It's not that like you incrementally have more money. It's the amount of money you have versus the amount of money you owe. So our $1,000 hedging against this. And two, other banks will likely fail, and you now have more money to be able to buy up their assets for pennies on the dollar because their assets are turning to shit. So we'll flip the argument about getting bought out from other banks, because you buy out other banks now that are taking this risky strategy because you have way more money to do so. This flips all their arguments on recession, and means on their house, when you're over fucking levered, that's when you're more likely to collapse. And they never also prove why you make enough money to even be in the consideration of the government's bailouts. Like, first, I'd argue that top 15 is still large enough to get bailed out. Secondarily is, if all the market collapses, they're going to bail out like the top fucking 5. They never explain to you why you would get into that top 5 in the first place. And the game theory incentive works against this. Because if this argument is true, then the banks that are currently top 5 or top 10 don't want to get displaced. So they're going to take on all the risky investments and make the profit that you're going to be making, which is you never actually get there in the first place. There's no way for you to get big enough to become top 5 in like the next fucking year. This is actually a ridiculous argument, and it just kills their case. On another case, basic framing, top 15 banks on the rise already have reasonable enough reserve. No, to become top 15, you likely have to do somewhat risky move, because banking is massively oversaturated as fuck. It's not enough for you to do slow and steady growth. So on their side of the house, you're already massively over levered. On our side of the house, our argument is that you still have those investments. Like, yes, there's existing clients that care about the investments you were doing, but our argument is those investments were likely long-term ones that you already have. So you're already happy with the investments that you have. It's just not to over lever yourself even more when it's in a time of fucking crisis. They say only way to be a fortress in a bad economy is to do next to nothing. No, it's like hedging your investments that I literally say, like dynamic delta hedging. Obviously, stop being resilient if you do nothing and let your money just lose value. This argument is just self-defeating, and it means everybody will pull off their investments. So no, that's not the way you fucking do fortress accounting. They say more rapid and stable rise and attract more investors who want return in the current economy. There are less of those investors than those who want to stay safe. They say people are scared and don't want risk. Guys, they say like investors are like super risk pursuing or something, but guys, if investors are pursuing risk, they would invest in AI or startups or fintech or hedge fund or a million other industries. Also, there's a difference between types of risk. Our argument is not that investors are fully scared of risk. Our argument is that the investors are scared of unknown risk. So that's why, for example, hedge funds exist. So they take advantage of risky opportunities, but they know what that risk is. Our argument right now is unpredictable what that risk is, because there's so many different factors, like international ones, or like the Fed politicization, and all of those bubbles that exist, which means that it's difficult to quantify that risk. They aren't willing to go into risk that they don't fucking know, because then the losses they take could be massive. So no, those investors don't just like risk, They only like risk when they are able to know that risk. They say probably smart bank, being able to break in the top 15. Guys, being smart means doing things like withholding investments during COVID. Saying you're smart and trying to equate it to every investment you make is genius doesn't make sense. It's because you're smart that you will be a fortress. They say real preference for investors to be risky. I already beat this argument. This is they say no banks fall into top 15. This is PMC's point. You've existed for a decade by now. You've probably withstood fucking COVID using a fortress strategy. They say market is amenable to risky paths. Notice and instability is bad, and obviously it's risk that you don't know. They say pass smaller banks by being safe is harder. That's fine, because the risky smaller bank is the one that will get bought out, or is the one that will likely collapse. So even if they pass you in the short term, they're likely to collapse when the market collapses. Both Diego and I agree on are likely to happen because they're over levered. They say regulation oversight means that Trump won't crack down on you. Trump cracking down massively on like the banking sector right now to like the Fed. They say they're able to do illegal things. Government regulators are super good. One, they get good lawyers to do student loan forgiveness. Two, they have massive money for opioid trials, tobacco and shit. So you can go after those for illegal things. Trump doesn't fucking like that. It's like you doing that. They say Trump helped BlackRock and private businesses increase American prestige. Trump hates investment outside the US and per PMC, which they didn't respond to. A smart investment right now is investing outside of America because it's on the table. That is that tension, because Trump will target your bank as one that is anti-American, because Trump wants mass domestic growth. Because you make smart investments on our side of the house by playing it safe. We don't run the risk of making the government fucking upset at us and taking us to court, or just straight up fucking buying our bank and not bailing us out. This is a double bind. Either you make a smart risk investment outside of the US and Trump targets you, or you make a bad risk investment in the US and get fucked. They say if you're a top 15 and a recession hits, your savings won't be enough to stop you. Guys, they don't understand how bailout works. Like I said before, it's the amount of money over the amount of money you have. And I already explained to you why that is. Like, difference is way more massive on our side of the house. They say you need risky investments to grow rapidly or shrink rapidly. None of PMC's slow growth models actually contest at all of why we're likely to still be able to somewhat grow on our side of the house. And obviously those risky investments are like stuff that you can't calculate. And it's probably just fine to play it safe. They say build a relationship with these investors. There's less of these investors, and you probably already have a decent enough on your board right now that are invested in projects that you've already taken on, not projects that you will take on in the future. Also, guys, investors aren't fucking like stupid as shit. You can explain to them, guys, the market is shitty right now. Maybe we shouldn't invest. Maybe we should wait or something. There's a better opportunity, like a better riskier investment that we know the risk of, that we could hedge better later down the line. So you can probably just explain to investors that way. On the on case, they say fuck it, bro. Take your chance. UFC underdog $5 bet to make $100. The other possibilities that the UFC underdog is getting fucking stuck cold and you lost $5. This example explains how risk works and nothing more. They say everything is volatile. There's no safe option. Just hold the money. The dollar won't crash. Or you can just arbitrage your bets or your hedges and stuff, or invest in other ways. That means you're not all in on something. They should better be governance good side by going all in on Trump's industries. Guys, going on all of Trump's economic plan is not fucking safe or smart, because Trump's trying to politicize the banking system and stuff like that. And also, obviously, a lot of its projects are domestic. There's a reason none of Trump's plans are going through. American regulations like fucking minimum wage making it impossible for America to compete to the market. Trump wants us too, and Ops' entire case attention, they want us to invest in super smart and appease Trump. The simple truth is impossible, as I said above. And the dollar is being harmed, but it's obviously not going to hit zero. Holding dollars and gold reserves is still somewhat stable. You can literally invest in gold right now, which is increasing massively because the economy is slow right now. Gold is at its fucking peak at $3,000 something. So that's probably a safe investment that you can do on our side of the house as well. They say banks get outcompeted by larger banks that are more resilient and stable. Top 15 versus top 5 for bailouts. I already explained why it's impossible to get there, but those banks are shit deep and stuff like buy now, pay later securities. This is the game. Your incentive analysis term that I give you, because large banks that will get bailed out are the banks that have taken on the craziest risks. You're more likely to be able to take their spot once they fucking crash, not crash with them. And they say banks in other countries are far more stable. They're more unstable. One, tariffs have been bad. Two, there's less bailout possibility. And three, obviously their currency is way weaker. They say, guys, rich people still want leverage risk. They will invest in your bank, especially given your growth and good performance. Even if they're investing in plenty of other banks, rich people aren't only investing in one bank each. And also they say some means of surviving in short term. Guys, the means of surviving in short term is holding on to reserves and not getting a fucking bank run done on you such that you can't pay off all the amount of money that you owe to your customers and your fucking people that you take out that from. Very proud to propose.
Cool. Yeah. Cool. Thank you, Diego, for debating with me. It's been a lot of fun. Didn't expect to get this far, and very happy that we have been able to. Thank you, opposition. You guys are both very good. I think this is the first time I've debated both of you, I think. And it has been a great amount of fun, even though both of our motions were finance-y, econ-y. Thank you, judges, for judging on Saturday evening. And cool. Ammo time. Starting in 3, 2, 1. It makes sense to be more safe when you're already big enough that you have sufficient client base to keep you making a profit margin. There's no requirement to be risky in that sort of condition when you're the go-to bank across the nation. You are, though, a top 15 bank. There is a massive discrepancy between the top 3, top 4, and the 10th through 15th banks in terms of the amount of power and the amount of control you have over your sort of investments and clientele. The conditions are different. You will always be outcompeted by the top 5 that have exponentially more capital to outcompete your sort of investments, whose existing grasp on the market means that their growth is relatively faster, because for each person they have a client, they're able to be able to reach exponentially more people, even if they are super conservative. We character and you are somewhat risky, but still abiding by the gov's ground. We characterize that the type of situation of a bank that is rising to 15th as per background and trying to move higher is dire enough that you need to choose traditional accounting and you need to take this risk now. And it is actually a prime time to do so, because no one else is thinking along the lines of now is a time to take a risk, because they do not, it's not in their incentive to take this risk. But I'll explain why you specifically, as a top 15 who has just recently risen to 15th, do have this incentive. The main thing I think they miss is the investor analysis here. their side of the house, you lose investors if you don't take more risks. They seriously are willing to see the bank fail. Otherwise, they wouldn't have chosen to invest in a bank that is rapidly on the move. That is, they are willing to see their money go. That is because, per background, rising through the ranks through a deviated strategy from, they are rising through the ranks, which means they are taking a deviated strategy from other banks that are probably playing it more calm, which means that investors saw that they were rising and saw that they were taking on some sort of more risk in the process of getting to 15, because they don't just spawn into 15th place all of a sudden. And they chose them specifically as the ones to invest in. That's the existing investors I'm talking about. And investors are just gamblers. They've specifically chosen a smaller bank that has probably shown a recent trend of doing risky things. I also think the analysis they give about this 399 and 411 and not wanting to lose that one, but wanting to gain, lose that one, so preferring to stay stable, is just wrong. If they put their money somewhere as a down payment, they obviously are taking the risk on that it might all go away because they don't have it on hand. They're not being conservative at the point of giving it up to some other entity. Also, if they preferred to see their money stay the same, they wouldn't have invested in the first place. Or they would have invested in a less risky bank than you, which means that they have incentives to do things that are risky. They would have invested in a top three bank, or like not a bank at all, like something even more stable. You have the opportunity to actually rival the top banks by increasing your customer base. This relies on taking the risk that your competitors won't. If others are being calm and chill because they're worried about the things government talk about, then you have an untapped opportunity for investors who are actually more gamblers, who are buying for a quick and easy fix for like power or more control, or like see their money go up. So you yourself say that investors are dumb. There is a subset then that even if it's only 5% who will donate their money to you, the chance that it hits, the chance that I don't know, 2 chips turns into 250 chips, sort of, because you are the only ones that's willing to offer that sort of payout, even and the risk for them is extremely small. Even if it is only 2% of investors in America, like investing in an American bank, the return on investment is so much higher, which means that you get the investors only on our side when you continue to do the things that you have shown a revealed preference to do, which is the risky sort of strategies. So you don't get investments, and you certainly don't get any more investments, because if you have stable investors, they're going to go to a top 3 bank or a more stable thing than a 15th ranked bank that doesn't have a national name yet. Even if this isn't true, they probably need a short-term payout, which is why they've chosen this firm specifically. So they're actually like more desperate to make money quickly, and they therefore have to take the risk of losing the money. They have some defense that they would invest elsewhere, but I think it's more likely that on their study house that they just don't invest at all, because you're just doing the same thing as everyone else. So we get at least some more investors on our study house for people who invest in bank or companies that invest in banks. Even if in the most charitable gov case, you're outcompeted on your side by big banks who already have far more reach, have far more connections with the community, have far more influential clients if you would take the same strategy as they are doing. I really don't understand how you emerge in markets like AI that are also being competed for by banks with far more capital in hand. We also have strategists who will choose the industries they believe are best for ROI. I don't understand why your strategists all of a sudden become risky in what you invest in. This is the issue that they have with their case. It's actually that you take risks insofar as you invest lots of money, which means you don't have a lot of cash in hand. That's the risk, but it's not the types of industries necessarily that you invest in that is the risky aspect of the bank's plan. Basically, you're using the fear of something like 2008 as a reason to not do something. But like that's such a small chance that happens, which is why the return on investment is probably like EV is like probably positive for people to invest into something that is expanding into more markets than their competitors, because they have more cash to be able to do so than like this 14th or 13th place that are taking it risky and seeing themselves drop down to 20th and not be influential as a bank. Cool. On being safe with your investments, I actually don't think that having higher cash reserves, for example, means you invest in safer things necessarily. Like you can still spend a lot of money investing into very safe things on our side of the house. The type of risk we're thinking about isn't like going to be just like investing in like, I don't know, crypto or like robots or something. It's just using money and keeping more of it in investments, which is what we're defending, which can necessarily be in the interest of the things that Trump cares about, right? You have analysts who understand the climate and who are going to be willing to invest in certain things and industries that Trump is not going to crack down hard on. I think that the sort of notion that we're going to just make silly investments is not the risk that we're actually taking on our side of the house. Also, larger banks are the only ones who get bailed out in the first place. They can see this. Like we say that it's possible to get to the point where you're powerful enough to get bailed out. It's only possible in our side of the house because you definitely can't outcompete like anywhere from the 10th through 14th best banks, but you probably can outcompete them if you choose a different strategy, which means you get to the point where you are able to be bailed out, especially if you're investing smartly in industries that the government has interest in supporting, and therefore interest in bailing you out in the chance that there's some economic downturn. But you need the clientele in the first place. You need to invest in industries in the first place to be able to get to that point where you have power to be able to be bailed out. So it's like where the only risk of solvency on our side is that you get to the point where you have some ability to be bailed out by the government if you rise through the ranks. And like they say that like this economic instability is sufficient to push you not to make this decision. The issue is like, even in the best case, this 2008 sort of disaster event doesn't happen for 2 or 3 years, to the point where you're probably already at the point where you're in the government's interest and being willing to be bailed out by that point. This is something you can do slowly and surely. And if you do, there will be someone that will come back. I don't know what that means. They also literally can see that the big banks are bailed out regardless of the debt situation, which means that even if you take on large amounts of debts in the process of trying to become a big bank, you are going to be bailed out despite the fact that you took risk to get there. The fact that you got there and have that clientele and have that reach means that you are within the scope of the types of banks that get bailed out. They say there's no way to get big enough in the next couple of years. I think you're wrong. If you're only bank rising this fast, then you probably are out competing your competitors. You also have all the investors, the gambling types, they're willing to put lots of money in for a high return on investment. I mean, if this pays off, then you obviously will get there. But even if it doesn't, over time, your EV is positive, as I gave the analysis above, which means that you're probably growing during this point faster than others. Maybe there's some risk of shock, but you're still growing. Also, you have you have not just a year or something like they sort of paint out to you, because there's literally just like this one shock event that might happen, but there's also some undetermined time at which point that shock does happen. This is literally a pivotal opportunity to rise, because everyone is saying don't. Trump will crack down as anti-American, they say, but international investors are different to what you do as investments. Like, you can invest domestically still. I don't understand why all our analysts all of a sudden like forget how to do their job and don't invest in things that are safe, even if they are taking risky measures to make those investments. Right. I have 40 seconds and one argument that might not be good. Also, it might be a bit silly, but I want to respond to this. If you have higher cash reserves, you're far more likely to get stolen from. This is like why Danny Ocean targeted casinos, because they have lots of cash on hand. You're also not making any extraneous purchases to the bank. So if you're being safe, which means your security probably isn't that good. This just means the chance that you get everything taken from you, which is definitely the worst case scenario. It's both a PR issue because you're viewed as super unreliable, and also a logistical one because you'll need insurance that's expensive, or you won't have that, which means you'll go under. The social divide is pushing more people to the brink of poverty. It's pushing them to take more risks, like stealing, to stay alive. I don't know. Even if there's less likely scale of harm, the extent to which this harm of getting your bank stolen from is outweighs and has to be responded to in PMR, please.
All right. LOR time. Two clashes in this round. The first thing I want to engage in directly with the MG. There's two claims that I'll concede from the MG and explain why, even given these concessions, we clearly outweigh their side. The first thing I'll concede is that a recession is relatively likely. We gave relatively similar mechanisms, and I think there's a good chance this happens, at least enough so we're like, given that there's some probability and a very high magnitude of that, in the case that impact occurs, we should take this into account. Secondly, on big banks during recession, I concede that one, they are the ones that do things like traditional investment and take on far too much debt. And secondly, that the US government bailed out banks in 2008 instead of the small banks with the large amounts of debt. There's three reasons why it ultimately weighs towards us. First, it's because it proves the warranty that we gave you in the LOC that the big banks will be aggressive, they will offer ROI to investors, and most importantly, that they will be bailed out no matter what because they are too big to fail. And if they do fail, the government always chooses to bail them out. This is true even if you buy like the politicization arguments from the MG. Secondly, this also means that you, as a small bank, even if you don't have large amounts of debt, won't be bailed out because the ones that they want to bail out are the largest banks that have a lot of debt, and it costs like tens of billions, hundreds of billions of dollars to bail them out. So it wouldn't be worth for them to invest into a smaller bank that has less holdings and doesn't give as much return to these companies or to the government. There's like less PR or whatever. There's very clearly a huge spectrum between being top 15 and top 5. I think that our analysis beats UK's assertion the top 15 are big enough to get bailed out. Like, bro, I don't think anybody here can name all 15 banks, but I'm sure that we can name fucking Wells Fargo, Discovery, Chase, etc. There's a clear delta as far as how many partners they have, how much economy they control, etc. Which means that insofar as they're guaranteed to get bailed out, the most likely outcome on your side is that you don't and you ultimately are forced to go under, even if you don't have debt, or that you ultimately get bought out by these larger banks because you're pressured to by the government. Third is that even if you survive the recession on the gov side, you'll likely get bought out by a big bank that gets bailed out. You waste above everything else because identity is prerequisite to all. You already top 15 banks, so obviously you don't want to cease to exist. The second class I want to engage in then is what do you invest in and how do you grow on the opposition side? The first thing I want to characterize is what the gov side looks like. First is that they dropped two warrants from the LOC that I think uplayer all their like fucking niche econ spec or whatever. First is that international banks will always outcompete you as a small and like fortress investment or fortress bank or whatever, because those are the ones that are the least subject to the Trump tariffs because they have all alternative because they aren't worried about like the fucking FCC regulations or whatever, because countries like the EU are establishing new relationship with China and Russia to have more stable investment absent like or due to Trump's tariffs. Secondly, is that even if that isn't the case, larger banks will always outcompete. One, because they will always get bailed out. So like it doesn't matter if I invest into this bank that fucking fails because they'll get bailed out and I'll get return on that anyway. So it's low-key like free risk. Why not go ahead and invest? But secondly, also because there's a far greater chance of returning of an ROI on their investment. There's these larger banks because they're the ones that have the most relationships, that have most diverse investments, that can invest larger amounts into more industries, and thus there's a greater chance that you get a return on that essentially. So all this goes to say that there is honestly a pretty low burden for opposition, given that they conceded those two arguments. We also there's like some decent chance of you surviving. That probably means that our side is ultimately going to be better. I think there's two reasons why we think you're better able to experience growth on our side of on our side of the house. First is that I'm willing I concede the MG argument that investing into other countries gets you cracked down on by Trump, and this is precisely the reason why you're likely to invest into domestic industries. But I think this is actually a good outcome for us. This isn't like a true double bind, as the MG puts it, because even if you're investing into volatile domestic industries, you get on Trump's good side, which increases the probability that you get bailed out post-recession, because he's like, you were America first or whatever, I don't want to let you fail because bad PR, and thus you probably get bailed out even before the recession, or if the recession doesn't happen, it increases the probability that the government protects you within the market, i.e. things like helping you ink deals to export to other countries who are on Trump's good side and don't have high tariffs. This ways above their Trump's politicizing the banks argument, because yes, you are right that he's politicizing the banks. The reasoning that is that you should get on the good side in order to avoid being on the failing side, not getting investment or not getting bailed out. This also is leading to investment, because the more you're on Trump's good side, the more that people want to invest into you, so a greater chance you survive on our side. Secondly, also attract delta hedgers, which co-ops prop analysis. Let's go. Browser up.
I forgot to give pleasantry. So thank you to Drexel. Thank you to CA team, Show Motions. Thank you to the judges. Thank you to Ryan. Apparently I got backpacked. I like it speaks or something. And then thank you to Diego and James. Diego, it always seems like I hit you on econ. And then James, I'm pretty sure we did debate before, like round 4 or something, but yeah, good luck.
All right. Pleasantries. Thank you to Drexel and every judge. Without you, we couldn't compete, especially because they're taking your weekend to judge us. Thank you to Yuki for what has been a wonderful tournament, and what I hope will continue to be a wonderful tournament. Thank you to the people from GW sitting watching our round and other spectators right now. It's very kind of you to be here and to listen. And then thank you to, I don't see if there are any spectators in the call. There don't seem to be, but if there are and I'm missing them, thank you to y'all too. Finally, to our opponents, this has been delightful, as was our previous round. It's really a good time debating y'all, and congrats on the semis and possibly further. Great job, especially if it was a last minute decision. All right, PMR will be similarly fast to PMC, but no one seemed to shout clear during that, so I'm sure it'll be fine. It'll be 2 responses and then like 3 ballots probably. 2 responses to Emma. 1, there's a reason one banking model is called fucking traditional. You probably rose through the ranks of banks during COVID by playing it safe via fortress banking as other banks went under or shrunk their balance books, which is the analysis from MG that is cold dropped. Even if you've made smart investments, part of being smart is knowing when not to invest in a given market, which is everything Yuki says that they don't respond to. Second, obviously, if you have larger cash reserves, you have an incentive in the capacity to hire better security. Also, you're a top 15 bank, so you're FDIC insured, so being stolen from doesn't fucking matter. What is the top line? Prioritizing long-term stability over the possibility of any growth right now. There's 3 reasons. One is risk of recession. The way banks collapse, as Yuki tells you to no response, is by holding more debt than their reserves can account for. That is the model of risk that we've outlined in this debate. What Ott fails to understand is that you don't just collapse automatically in a recession if you're a small bank. You collapse if you're a small bank who is over-invested and doesn't have enough money or the promise of a government bailout to get out of that. Small banks survived 2008 if they had played it safe. It's not like every fucking bank in the United fucking States collapsed in 2008 and only the ones that survived were the ones who received bailout. Second is slow growth. They don't contest our 2 stakeholder analyses. One, current investors know the market is risky and want their money to stay safe, and they trust you because of your previous success, especially during COVID. And second, new investors, rich people who are looking to leverage their risky investments in venture capital, AI, buy now, pay later, etc., or otherwise place their money in you as a bank that has been smart and has saved well. And importantly, what they don't ever answer from the MG is the fact that wealthy investors have enough money to put it in multiple banks, which means just because they're invested in top banks doesn't mean they can't also invest in you. Third is the bailout model. The banks that do get bailed out are top 5 and top 3. As James very conveniently informs us, these are the banks that are taking on a ton of risk, and these are the banks that are way too big for you to possibly compete with. These are the banks Op is trying to compete with. They don't have a single reason on the flow why large banks are playing it safe right now. As we have proven, the banks that are assured a bailout are the same banks willing to take on more debt because they aren't at risk of collapse the same way you are. This means 2 things. One, there is nothing you can do to access a bailout. As Emmo literally says, the large banks are magnitudes higher and bigger than you will get in the near future. These are, even if you do take the riskiest investments and you somehow get it big, the large banks took those same investments, which means they grow at the same rate as you, so you still don't overcome the gap that both teams have pointed out. Second, playing it safe is a novel market strategy because traditional banks outside the top 5 are still taking Op's path, given it's the traditional path, and nuking their stability. On a weighing level, 1, if you go under, it is highly unlikely you'll get bailed out. Even if you do Op perfectly, you still won't get big enough to bail out because every other bank is also investing in those risky paths. Given Op's entire path to victory relies on receiving a bailout, and per their own admission, the size difference between you and Chase Bank is enormous. They have no offense. Also, they cold drop that the market is near impossible to grow fast in right now, especially with less cash to invest as massive banks. You can just weigh the following. Op's strategy of somehow either becoming top 5 or investing in American manufacturing industries that literally don't exist versus our strategy of just investing relatively low amounts in domestic currencies or gold, not incurring the wrath of Trump, not taking a risk in the market, and just weathering the recession the same way you weathered COVID. I think you prefer the strategy that is almost certainly going to succeed. Second is a bank run. Op literally just gets hit by a bank run. They hold a ton of debt on variable rates from risky industries Trump wants them to invest in. The Fed's rates change, and suddenly you don't have financing to cover the debt. Their response is that investors are fine with losing money. 1, this is nonsense. There's obviously thresholds of risk. 2, the analysis about the type of risk they care about is dropped from the MG. They only like risk when it's quantifiable and calculated. We've explained a ton of factors that make Trump's industries and Trump himself unquantifiable and incalculable and super unstable. That's the risk they don't want to take. 3, even if that's true, that's not true of your retail customers who put paychecks in your checking accounts. As soon as they see you doing illegal shit while being over-leveraged with very little reserves, they will pull out their savings from you, which is a massive amount of money you lose and causes insolvency, and you're not big enough to get bailed out yet, so you're just fucked. So we're proving investors pull out on Op. But even if investors don't pull out, your retail clients do pull out. This gets around the nuance of the LOR argument of you are outcompeted, because it's not about competing for new investors or customers, it's making sure current customers stay with you. The bank run short circuits around, you just collapse and you're not big enough to get bailed out. Finally is growth. What's even better for Gov is that our growth model is untouched. 3 things. 1, we maintain existing shareholders and investors who trust us and who recognize our strategy is low risk. 2nd, we attract new investors. These are rich people who invest in many banks that already are invested in the top 3 banks that are doing risky things and want some money in a smaller, safer bank. 3rd is savings and checkings account. Regular people who track market trends and see your bank rising, they'll think it's a good opportunity to join the wagon. There are also forms of long-term investments that don't necessitate high debt, things like gold or historically stable industries. What does this mean? Even if you don't take on the risk of the Op and do the Gov, we still grow, so we get all of the benefits. We are incredibly proud to propose.